All right, so to start this off, where I'm just gonna do a quick overview of the previous lesson since I wasn't able to complete it all in one sitting. It is WOLFPACK Technical Analysis 101 Alpha lecture. And before we covered most of the basics of technical analysis, which included trend lines, how to draw the supports, the resistance, the ceilings, as well as the time span of the candles, what you want to look for, what you want to focus on, and how they all work and are correlated to one another. And then I also covered the stop losses for risk management portion, and how to use alarms instead of stop loss, which could be very beneficial in case there's a stop loss hunt, or you just placed it at the wrong spot and it ends up coming up higher. I also covered a lot of patterns. That's what took up the majority of the time, I believe. Some of the patterns that I covered were the reversal patterns, the falling wedge, rising wedge, double bottom top, triple bottom top, head and shoulders. The continuation patterns, bull and bear flags, bull and bear pennant, 3-point drive, wedges, and then the bilateral, which are the triangles, symmetrical, ascending and descending. These are all the different patterns that we discussed and we covered in the previous portion of this lecture, and we will be focusing on the finalization, which are the basic indicators. So these basic indicators there's a very large volume or library of indicators that people can use. These are just the ones that I personally use. I think that it's better when you don't use too many indicators. Sometimes you'll see charts with just 20 different indicators all just splashed on top of each other. It's good to understand them because you have a wider range of basically weapons at your disposal in terms of for reading the technical analysis and analyzing the charts. But I think that having too many indicators can work against you, because usually when you have too many indicators, you'll soon find out that one indicator will say one thing. One indicator will say that the price is bullish, and then another indicator will be will say that it's bearish. So you'll have these conflicting signals on whether you should buy in, you should buy out, sell, etc., etc. And if you have too many indicators giving you too many signals, it's really gonna mess with your decision making in trading. So just with these indicators that I usually use, I still get a lot of mixed signals, but I've come to hone my skills, I guess you could say, with these indicators. And at the same time, even though I do have a lot of these indicators, the Bollinger Bands and the Ichimoku Cloud and all that, half the time I don't even use those. I kind of use it just to get a little bit of clarity towards where the market looks like, if it's too far away from support, or if it needs to be shorted, or it's just overbought, or etc., etc. But the main indicators that I really do use is the stochastic RSI, the volume, and also the order book at times. As far as the Bollinger Bands and the Ichimoku Cloud, I don't use them that often. Like I said, I just use them to get a clearer picture of where the price could possibly go. So anyways, so to start things off, the stochastic RSI is definitely the #1 indicator that I use. I love it. If I can only have one indicator to use ever, it would be the stochastic RSI. The difference between the stochastic and the regular, I just find the stock RSI being easier to read. It's waves that go up and down from 0 to 100, and you can see the buy and the sells, and when they cross, it's the perfect time that it's gonna flip over, and etc., etc. I'll show you an example in a second, but that's definitely the #1 indicator that I use. RSI stands for Relative Strength Index, and it's basically an indicator to tell you when something is overbought or oversold. It's not 100% right all the time. Whenever there's any sort of manipulation at play, or a big rally at play, sometimes you can get mixed signals from the RSI where it'd be really high on like the 1 hour and it's coming down, but at the same time the price is like shooting up. So that, I mean, that'll happen quite frequently. That'll happen quite frequently. But you just have to be aware of that, and after a little bit of time and experience using it, it kind of, you just learn to read past that and not take too much attention on that. Pay too much attention on that. One of the next indicators that I usually have on my charts is the Bollinger Bands. The way that I use the Bollinger Bands is mostly I like the Bollinger Bands to see where compression is going to be at. I'll explain it in more detail in a little bit when I pull up the charts. But usually when there's compression going on, it tells you that the price is going to move either which way, up or down. It's going to have like a big dump or a big pump. And if it's compressing, if the BB bands are compressing and there's a bearish pattern in play, or the support, it looks like it could break support, or the volume's not there, like in collaboration with the other indicators, if it looks like it's bearish or bullish, the Bollinger Bands will tell me where is basically the best spot for it to, pump up or pump down. In terms of being overbought, it's also a good indicator for whenever there's like a really big pump up, like a crazy FOMO pump up, and it starts breaking the Bollinger Bands. You can feel pretty safe selling out there, like if you're gonna ride the waves or short sell it. You can feel pretty safe selling out when it breaks the Bollinger Bands and just buying in lower, because you know that it's already overbought. The Fibonacci levels. This is something that's very, very commonly used within the markets. I personally don't use them that much, simply because people use fib levels and they place them in spots all over the charts basically, and a lot of the times they'll place them incorrectly. So if a portion of the market is using the fib levels incorrectly, because I think it's safe to say that a lot of traders and a lot of the crypto markets are not professionals and are not experts at TA, so you'll have a lot of people using all of these sorts of indicators or tools, like the fib levels, incorrectly. So if you have a set of people using fib levels incorrectly, then that could give off bad signals basically. You want to use tools that match most of the market's mentality, because then you'll be moving with the market. If you're moving for the most part with the market, then you have the edge on everyone else that's moving against the market. So that's why I don't really like fib levels too much, but if you do place them correctly, they could be, or they are fairly accurate, especially during things like Bitcoin retraces and corrections and all of that. I think fib levels are actually more accurate with Bitcoin, since Bitcoin's this massive beast of a coin, where it doesn't move crazy fast like the altcoins. The altcoins, I don't use fib levels that much, simply because they're so volatile that they're not as predictable as Bitcoin. So that's my 2 cents on that. The Ichimoku cloud. Ichimoku cloud is a Japanese indicator that is used mostly for swing trading, not really day trading or anything aggressive like that. That's mostly for, if you want to check the charts or check the price, or, check your investments like once a week. You'll come in and if it looks like a good buy, like it's breaking through onto the bullish cloud section, then that'll be a signal for you to buy, and then you just basically wait until it crosses over the clouds again, or et cetera, et cetera. Ichimoku clouds are not meant for aggressive, fast trading. However, they are very, in my opinion, good at identifying, bear and bull markets, and also the supports whenever it hits the green Ichimoku cloud support. There is a split within the crypto market on the Ichi cloud with using the regular basic settings as opposed to the 24-hour settings. I personally prefer to use the regular settings over the 24-hour, simply because not that many people know about the 24-hour settings, and I've just found that the regular settings are more accurate than the 24-hour settings. That's just my personal experience with it and my personal opinion on it, but I've used both of them, and I definitely like the basic settings a lot more than the 24-hour ones, like the Forex Ichi clouds. With volume, I use volume a lot to see if we're falling for a trap, where the coin is going. You can use the volume for quite a lot. you'll see volume in a lot of the charts that people post up with their TA, but not that many people use the volume indicator that much, simply because, I mean, I don't know. I think I read into it a lot more than most people, but it's a really good indicator for you. It's a really good tool for you to see if, you know, the logbooks are just super thin. You know, if you see that there's like panic going on, or like a big, you know, red candle coming down, and the volume is extremely thin compared to, you know, a giant spike prior that had like a huge massive volume spike, then basically you could just from that you can tell that the logbooks were just really thin, and some people were just selling out and dumping. But because there's a bunch of people that bought in at a higher price, or there's a large buy volume around that same area, and a little bit of a sell volume, then you can basically assume that the price will more than likely come back up, just because there's so many bag holders. You know, the people that bought in at a massive spike of buy volume are most likely not going to sell out immediately unless they're just complete noobs. You know, usually they'll wait until at least like the next leg up or something like that. The order book, I'll also go over that, and I'll go over what spoofing is. Spoofing is basically putting up a buy or sell wall that you don't intend for it to get filled. You just use it to psychologically, I guess the correct terminology would be, to manipulate the markets for mostly the noobs that sit there and look at the order book and start to panic when they see that there's like this big sell wall, or, you know, or start to FOMO in because they see this big buy wall and they think that, oh, you know, there's a bunch of people trying to get in, like I'm gonna get in first, and they just start, like, you know, buying in at the market price. So I would recommend, actually, if you don't have experience with being able to tell the difference between spoofing and real orders, to just not look at the order book at all. I look at the order book simply because it's pretty easy for me to tell, and hopefully you guys will be able to tell too after this little lecture. But if not, then try to stay away from looking at the order book. AFK walls, I'll help you tell which ones are the AFK walls, and they're, in my opinion, they're pretty, they're most commonly placed in even numbers without a bunch of different decimals and or satoshis and all that stuff. So if there's, like, for example, Bitcoin, it's at like 97, and then there's like this giant sell wall at 100. That's most likely, or let me rephrase that. There's the price is like 97.62 whatever, and then there's a big sell wall at 100 period 00. That's most likely a real wall, and it's mostly placed by swing traders or just noobs that want to sell out higher, and they don't think about placing sells at, you know, a dispersed area. They just lazily put, you know, $100, when in fact if they put 99.97, it'd be a higher chance of their sell orders getting filled out instead of just placing $100. But those AFK walls are mostly just swing traders, or just lazy people, or just noobs that don't know any better, and they're just trying to sell out at easy number that easily comes to the mind. Buy and sell walls, like I said before, they're mostly spoofing, but I'll help you figure out how you can tell the difference between spoofing and the real ones. And then there's depth charts. Don't look at depth charts, period. Depth charts are, in my opinion, nearly useless, because you'll see, like, oh yeah, there's this giant wall, and you can see like all this red or all this green, etc., etc. But those are usually spoofing. Those are usually just whales trying to play the market. So depth charts are useless almost. So anyways, that's all the indicators. So let's go over to the charts. And this is something that I'm going to show you guys in the next lecture, the TA 101 Bravo, which would be a lot of the more in-depth, more advanced TA patterns, ABCs, Elliott waves, etc. Alrighty. Let's just close out of this, clean it up a little bit. Alright, so first things first, we're going to cover the stochastic RSI, which is this tool right here. People always ask, you know, what are your settings? I use the basics. That's it. Never touch it. Don't just leave it alone. Most people use it because that's how it comes. They don't go in here and start changing things. You want to play with the market, not against it. So you use the regular one and it works fine. So stochastic RSI is mostly to see when something is overbought and oversold. The red line right here would be considered the sells, basically. Blue line would be the buys. So whenever they cross, that's when the buys and sells are gonna swap over. And then if you look over here to the right, there it goes from 0 all the way up to 100. 100 being completely capped out means that it's completely overbought. It needs to retrace and consolidate. At the bottom at 0, it means that it's completely oversold, and it needs to go back up for a nice little juicy pump. So you would want to basically sell whenever it reaches the very top at 100 and buy back in whenever it's at the very bottom at 0. And if you look right here, so let me just kind of scroll this like that. There you go. So you can see right here, right? If you look at the crosshairs, so this right here at the bottom in the RSI is at 18, right? And then it starts going up little by little. And then right here after this candlestick, we have this giant little rally, this big buy volume candle. And you can see that it starts to rise up at the same time with the RSI, and it's going to keep doing that, keep going up little by little, the hard candles, until it becomes completely overbought. Right there, it goes to 100 right here, and then it crosses over and it's completely overbought. People start taking profits, and that's when it shorts down all the way down until it consolidates to the very bottom, the RSI right here, and then it swaps back up. And then you can see this entire thing right here, it goes all the way up green for a nice big rally, and that's from here all the way to here, and here actually. So it goes from here, all green, as the RSI is going up, completely matches it perfectly. And then from right here, it's at the very, very top for a while actually, at 100. So you can tell that right here, you need to sell it. It's overbought, and that's exactly what people did. They dumped this down, this giant candle right here, and then this is one of the false indicators of the RSI. This is where it shows you that you can't just rely only on the RSI. You have to use other factors in play too. So right here is where it starts going down. But if you look at the price, it came down right here, and the very next one, the RSI is also coming down, but look at this. The price even spiked up even higher, and then it came down again, and then it, some more green volume. It came up high again, and then a nice big dump, and then that's where it starts right here. It starts having the little J-hook reversal. Rest in peace. Little reversal right here, even though the RSI is still going down, but now it's at the very, very bottom, and you can see that the buys are starting to come in. The blue line just angled up a little bit, and the sells, since you saw this green candle just got chomped down a little bit, the sells are still over the buys. So we're still seeing a little bit of resistance. But once that crosses over in the next candle, we're most likely going to go up for the next leg, which would, hopefully probably end up somewhere up here. There you go, see, buy volume coming in. So this is going to go up, a little bit, and then the price is going to go up a little bit, and when it becomes too high, when it's overbought completely, that's when you want to short it, wait for the RSI to come down a little bit, and then buy back in when the RSI is near the bottom. So if you sold right here when the RSI was completely high and bought back in down here at the bottom, it would have been a 8 something, like a 8% short, which is pretty awesome. Yeah, like 8-9% short, which is great, because in the next leg up, when it starts coming up higher and you buy back in with all of that short sell accumulation, then you'll be getting however high this thing goes, however high this one goes. Like say it goes up 15%, you'll get 15% of your original stack, but also 15% of the 8% that you just shorted. And if you do that over and over and over and over, that's how you start accumulating a lot of money. It all grows exponentially. So that's why wave riding is extremely, extremely profitable. But at the same time, it's also very risky, because you risk not coming in, not coming out. I personally like to wave ride with portions As I said before, usually like 20%, at the most like 50%. Just in case you don't get back in, you just take the profits, and you just take the profits for yourself, and then you just continue to whatever you have in there with, for the rest of the pump. So that's my strategy, that's my tactic. That's how RSI works. Now, with that being said, you don't want to look at just one time span RSI, because you're only working with limited data. So if you see, for this is Funfair, so the 1 hour is bullish on the RSI, it's very bullish. But then as soon as you cut into the 4 hour, you can see right here that the 4 hour is completely floored at the top. So this needs to retrace even further. So let's draw this out, right? And then also let's do a little ceiling from here. Let's see, probably something like that. So this is a nice little, this was a ceiling that broke out of, and now, as I stated before in the previous part of this lecture, now that it broke out, the price is over it, so this now becomes a support. So I believe that Funfair is going to go up a little bit because the 1 hour is up. So we have at least 1 hour of bullishness still, so it may go up a little bit more, and then after that it's going to correct down, and it's most likely going to break this trend line right here, and it's going to come down onto this support. So if you short sold it here, about down here, it came back up, you shorted all, like your entire stack here, and then buy back down here, and then continue on with the rally, you will quickly gain a lot of income like that. And you just basically just keep doing that over and over and over until whatever catalyst you're playing goes into the full breakout, FOMO, Neo, like going parabolic. And then once that happens, you just exit out, short it, or like place a bunch of orders along the way and just get out of it, take all your profits, and then move on to the next coin. That's the aggressive day trading mentality, instead of the hold forever long-term investor stuff. The Funfair is a great coin. Don't get me wrong. It seems like it's gonna have a really, really big future ahead of it, but as a day trader, you want to. It's all about profits. Like sure, you can get into Funfair again later, but once it goes into the crazy FOMO rally, you want to sell high, buy low. So you just sell it there, wait until it comes back lower, and then you buy in. And it's always a game just to try to get as much of the coins as you can than everyone else. So anyways, so you want to check out the multiple time spans. So the 4 hours completely at the top, the 1 hour is completely at the bottom, and then if you look at the 1 day, the 1 day is almost at the top. What this tells me in the longer / short term period is that we're going to go up a little bit due to the 1 hour and the 1 day still having some space to go up. We're going to go up, and then the 1 hour, the 4 hour, and the 1 day are all going to be at the top. And when that happens, it's going to come down for a hard correction. So you want to get out of the markets before that happens. But if you look at, let's look at the 30 minutes. You see the 30 minutes still at the bottom too. Let's look at the 15 minutes at the top. It's going to come down. So right now we're going to see like it's a little leg up. We're going to see some sideways action here, and then you're going to see another push up for the 1 hour. You just look at all of them and combine them all together to get a clear view of what's going to happen with the market. Like right here, you can see that the buys are finally overlapping the sells, so we are going to see this little next leg up. So that's the stock RSI. Definitely my #1 tool that I love using because I'm an aggressive trader. I like to short sell. I like to accumulate on the way up and then just dump it all at the end. The next thing I want to talk about is the Bollinger Bands, which is this blue stuff in the background. So the Bollinger Bands, if John Bollinger, if you see this, Big Daddy B, thank you very much for your contribution to the trading communities and everything. Mad respect. With that being said, I don't use the Bollinger Bands that much. Like I said, I use them for compression. So you'll see, like, whenever there's, look at this compression right here. So you'll see that whenever there's a big pump up, like right here, like this giant pump up, right? the Bollinger Band gets broken by the candle and it expands it. You see how right here it's like the space is growing in between. The space is growing. So when it pumps up, that means that it could eventually come all the way down to hit this bottom. But of course it didn't, because there was really no reason to sell. So it just went sideways a bit, went sideways until both the Bollinger Bands came in and compressed at a certain point, which is right here, and then there was a dump that brought it down. But it wasn't that big. If it was a bigger dump, then the Bollinger Bands would have opened up again. But it came down to right there, and it just basically rode the Bollinger Bands down, and then it came back up, and you can see that it always respected the bounds of the Bollinger Bands. So it came back up over here, chilled at the top a little bit, continued going sideways. It broke it a few times, which is why the Bollinger Bands didn't really compress all the way like it did over here. Like you can see this over here, it's just really tight compression. There was like no price movement left or right or up or down. It was just all just within the Bollinger Band. And then over here it started expanding because it started getting some pumps, and then this is where the real big pump, you could see that it broke it and it stayed breaking it. It continued breaking it for a while, and as soon as it like this candle is almost completely out of the Bollinger Band, that's a clear indicator that it's overbought. It's really overbought, and it needs to retrace, it needs to cool down. So that's why as soon as this candle closed out, you see all the big sale volume coming in, because it needed to get back within the bounds of the Bollinger Band. And it also matches with the stock RSI. So it came down a little bit, hit a support. Now it's within a safety zone. It has space to go up to. It could basically go all the way up to here, like 850-ish zone, before breaking. I mean, it'll break it at 830, but most times if it's really bullish, it'll break it a little bit and then it'll come down. So I think that's what's going to happen. It's going to come up, probably challenge the 830, even though there's little resistance right here. I had that drawn before, but I believe that with the 1 hour RSI, it's probably going to come up and break that triangle. And then we'll see some price action, at least a little bit above over here. But if you look at the bottom of the Bollinger Band, there's a lot of space. That means that this once it retraces, it has a lot of space that it can come down and retrace. So you want to keep that in mind. If you sold out here, you don't, and you didn't get back in like down here, don't FOMO in, because if you see the Bollinger Band, you can tell that it's going to retrace back down eventually. Maybe not today or anything like that, but it should be retracing down eventually, or at least until the Bollinger Band comes up and catches up with the price. There is a strong bullish catalyst with Funfair, so a lot also depends on that, but over time we'll just see if the bullishness from the catalyst is strong enough to break all the indicators. So that's the Bollinger Band. Like I said, I don't use it that often, but it is a very good indicator. I know Collapse uses it, or Nikita, and he uses it pretty good. The next indicator I want to talk to you guys about was the Fibonacci levels. So the Fib levels, or Fib retracement, it's also called. The Fib levels, the Fib retracement, since you can manually place it yourself, I feel like a lot of people can mess that up. And then not only that, but you can place them everywhere. I mean, like you can place it right here. Like if you placed it right there, it's a lot different than if someone were to place it with just the candles, right? Because what if they just use the candles? Then look at that. There's a big difference between that, right? See that? You see the lines in between. If someone wants to get back in at the 0.5 and they're using the wicks, they're charting by the wicks, which by the way, I always think that you should chart from the wicks, and the whole purpose for that and the whole reason for that is because in the 1 hour, this is the candlestick, but if someone does a Fib retracement on the 15-minute, the candlestick heights and the wicks and all that are going to be completely different. Let's see. Or if you do the 4 hour, see, look, if you did the 4 hour and you were only doing hard candles, then it would be all the way down here. It wouldn't even make much sense. So you kind of always want to do the wicks, because the wicks never change. The wicks, the very, very top never changes. It's always going to be right there. It doesn't matter, no matter what time span I look at, the wick is always going to be right there, the end sail. And I do find that that's the most accurate. That is actually the correct way to use it. A lot of people use like I said, the hard candles, but you shouldn't do that. You should be putting it from the wicks. So anyways, the fib retracements is basically like the psychological mindset of something that's being, or the mass psychology of when is good to buy in, when is good to sell, like when the market's bullish or bearish, like down here in the red. It's basically, in my opinion, a buyer's market down here. And then when it comes all the way up here, like that, this is like the FOMO, when FOMO kicks in, like, something goes all the way up to 100, and then FOMO kicks in, like you'll have like these giant spikes, and this is like the danger zone, etc., etc. That's what I know that's not what the actual proper names of all this is. That's just what I call it. I don't care too much about the history and the back end knowledge of TA and who Elliott was that created the wave theory and this. I don't care about that. I just care about the tools, using them and using them properly so that they work to my advantage. So anyways, so with the fib levels, a very strong bounce indicator. If you look at, let's look at Bitcoin. So if, let's see over here, let's do 4 hours. So whenever there's like a big correction, one of the main times that I use fib levels is whenever there's a big correction from Bitcoin. So I'll put top of the wick, bottom of the wick, and you'll be able to see all of the bounces in between. So it bounces down at the bottom, it comes up, it just breaks the 0.382, comes back down, bounces on the 0.23, comes back up, and like this, it just matches perfectly. It's usually how it works. And then it breaks up here, but there's not enough buy volume. It hits a Bollinger Band, etc., etc. It comes back down, breaks 2, and then it bounces like closer to the 0.23, and then it comes back up. Once it breaks this 0.5, which you can see right here, there was a ceiling right there, which is basically the 0.5 psychological barrier, basically. Let me zoom in a little bit. So anyways, so there's like a little psychological barrier right here. It's actually this line that I can delete. But that was the fib level, the fib ceiling. Once it broke that, it had a nice little crazy, rally, short sell, or a short squeeze rally that came up, and then it just broke the next fib level, but it wasn't ready for it. Came back down. Now it has this little ceiling of the fib level, and now we're just breaking it again. And then once we break that, it's most likely going to have another nice little rally. Hopefully, it's probably going to break out of that, hit the ceiling right here, bounce around a little bit, break it all the way up here, and hit that. But that's what the fib levels are for. I don't use them that much, like I said, because they're, in my opinion, they're not. I don't know. I just don't like them that much. The only time I ever use them is whenever there's a big crash in the bounce. You can tell like where the channels are that it's going to be moving in between, and the psychological barriers and all of that. So it's a very useful tool. A lot of people like it. It's extremely common, very popular within the trading community. If you've been using it, I recommend mastering it, getting to know about it a lot more. I'm just not that big into doing the homework behind understanding it completely, but it is a very powerful tool. The next thing I want to talk about really quick is the Ichi clouds, which are, let's close some of these indicators so that you can sort of see it a little bit better, which are these like red and green little weird squiggly border things, like right here. So the way that they're formed is they're actually formed by these lines, this red one and this blue one. Whenever they cross, there's like a I forgot how long forward it is, but there's a time span forward that it basically mimics. It recopies them, and it pushes forward like a prediction of where the supports will be at and where the sell pressure would be at, which would be the red. The red is the sells, green would be the supports. And I think it's like if you do like a 1 day or something, it's like a couple days ahead. Let me see. So I think it's like 40 days or something like that. So from right here, yeah, it's about 40 days. 40 candlestick period, basically. Zoom this in a bit. So for the 1 day, if you're looking at it from 1 day and you're sort of swing trading, you can see right here that it bounced. Technically, the hard candles didn't even exit the green support cloud. So if you were to sell it right here, because it's too far away, you can see that it was clearly too bullish. There's too much space in between the price and the cloud, which would indicate that it is overbought. So it comes all the way up here, and it continues to FOMO rally all the way up. And there's this wide distance from the cloud and the price. Then just by trading with just Ichimoku, you get rid of all of these little other indicators, which, let me just do that right now so you kind of grasp the concept. Alright, so I'll just leave that there. But if the price came all the way up here and it's too far from the cloud, and you see that the cloud is starting to kind of go sideways, because over here, as it started skyrocketing up, you also could see that there was this like sharp incline. So it's gonna follow, the price should follow this incline. But once you see that it starts coming sideways, if you look at the cloud, it started going sideways, then that's an indicator that you should start selling out, especially like if it's starting to go over the cloud almost instead of directly to the side of it. Then you sell out, and then you wait until it hits the buy zone, which is this green cloud. That's where the support's at. So if you were just to sell out there, the indicator was that it's too high. It's overbought. You sell out there, and then you just place an order at the green, somewhere in the green cloud. You would have made a nice little short from there. You placed it down there. You would have made a nice little 30% short, and you didn't even have to do anything, like no lines, no charting, anything. You just see that it's overbought, and you just want to buy it within a green cloud support zone. So you just leave the order there, and it'll come in, it'll fill out, and then now it's within here, so it's like a buyer's market basically. And then once it gets out, it's going to start doing the FOMO rally, pass this entire like red cloud that's being made, most likely going to form like a red cloud over here, and then a green cloud again going up. And once it does that, you want to sell it, like I said, once it starts going over it again, and then just buy back at the green cloud. If it breaks the any of the clouds, if it's above the clouds, that means that it's bullish. If it breaks the cloud and it's below it, it means that it's bearish. And usually whenever it hits the hard green line, that's a buy signal. It'll usually either bounce it and respect it, or a red line would trigger a sell. So for example, for this rally over here, for the entire thing, you can see, pumps up, overbought, too far away, it gets shorts down, and then it comes down into it actually breaks the cloud, comes down a little bit over here. When it breaks the clouds and it becomes bearish, it's usually signal for a buyer's market. Above it, way above it, is seller's market. Once it goes low, either into the green cloud or below it, it's usually a buyer's market. Seller's market, buyer's market, and then it comes up, spikes up all the way, FOMO rally. Is too far away, you sell it there, it corrects all the way down, breaks down here, and buys it again, because this becomes a buyer's market down here. You're buying it on the cheap, basically. Buy it up, it comes up, continues to rally all the way up, people sell it, comes down, buyer's market, and it continues to go up. Same thing. So it's going to go all the way up. You sell it when it's too far away, you buy it within the cloud, or when it breaks the cloud, you just like leave an order there, you track it, and when it's in the buyer's market, you pump back in, you're most likely buying the bottom. So that's the way that the Ichimoku clouds work. Very useful tool, especially for swing trading, for the people that don't have the time to sit there and chart it and track these things for extended periods of time. If you're doing like a more longer term trading, that's what Ichimoku's supposed to be used for. Another indicator that I like to use is the volume, which is this portion down here. You know, the red and the green bars, that's the volume. And then it kind of tells you like the depth of the volume with the blue wave right behind it. So not that many people use the volume that much, but you should really pay attention to the volume because it tells you a lot with the market. For example, just by analyzing the volume here, you can see that this green big bounce has a massive amount of buy volume. That's very bullish. The fact that it has this massive buy volume that isn't, you can't see it anywhere else. Let's see how comparable it is in the long term. Look at that. It's not comparable until right here. That's this giant massive spike right here. So when was that? That was November of 2016. Jeez. See, so this in the beginning is when there was a lot more buy volume than this. But aside from this 3K bounce that everyone got into with the latest correction, aside from that, there's not much else. Like I can put the crosshair so you can see the top. There's not much else around here, like in between back then and now, that matches that volume. So because there's so much buy volume, period, that tells me that the market's pretty darn bullish. Because if there's a bunch of people that bought in right here, then they're not gonna sell out until they get substantially higher. So at least like up here, and for them to sell out up here is most likely unlikely because there's a Bitcoin and there's a lot of people that like to hold it for long periods of time. But still, that makes me feel more secure and safe that this little correction bounce is not, that it's not going to come back down and crash down and we're going to see, 2,500 or anything like that. This is basically like a good anchor for Bitcoin's price. So from here, I could see it only going up for a while before we see another big correction. That's one way of using the volume. Another way would be, let's see. So like you can see right here, this is a pretty big buy volume right here. And then the price starts to come down, but the sell volume is like minuscule. So that just goes to show me that the order book was probably very thin. You could probably see it a lot easier in, looks like it's bouncing around. You could probably see it a lot easier in games like, or in coins like this one. So actually this is a perfect example right here. There's pretty decent buy volume. If you look at the buy volume right here, the bar is a lot bigger than this tiny bar. But at the same time, you see like this massive red candle. That just indicates that the books were thin. And the same goes for, if there's this giant green candle and it's like this tiny little volume, like right here, like there's like this big candle right here, and for the most part, there's a pretty small volume. It just goes to show that the order books they're empty, or they're like a lot of really small orders. So people just pump in and it made this huge candle, but it's not a solid price that could be sustained. There's not that many people holding the coins at that price. So it's like an artificial pump almost. And you want to try to avoid that because it can signal, bear traps, bull traps, just like false pumps. Like you'll see a coin go up really high and there's not that many people buying it, and it's a false pump basically. Like you wouldn't want to get into the coin with the false pump because everyone else that's holding it will see that price and it'll be easy for them to just sell it and dump it down, kind of like what's happening right now right here. But at least we have this buy volume with some pretty decent or this candle with some pretty decent volume behind it. So you want to look at the volume indicators for that. And also, a good indicator that the volume gives is the interest within the market. So you'll see that. Let's see. You'll see that the market usually bubbles up in terms of volume. So like right here, right? So it'll pump up the price because of all the buy volume. People kind of FOMO in, and then as the sells start coming in and there's not that much buy volume, people start selling because they're taking profits or whatever, and it starts to trickle down. You always see like this little bumpy like bubble pattern everywhere though whenever it bounces. Like right here basically, but it always goes up. It always goes up, and then people get tired of it and it kind of starts going down, and then it starts to bleed because there's no buy volumes. People just start selling out because they don't want to hold bags or whatever the case may be. So it bubbled up over here, came back down. The price reflects it exactly. Bubbled up over here, came back down, and just bled. So right here, we're kind of in the beginning of like this little bubble thing. I'm hoping that with the news that's coming out, that it'll go a lot more, and we'll see, you know, some more buy volume coming in to kind of propel the push forward. If the news takes too long to come out, then people are going to get tired, and the bubble is going to start, or the volume is going to start to bubble down and kind of dwindle and just bleed out until the news does come out and people start getting bullish on it again. So that's how the buy volume works. Now, in terms of reviewing the order books, right here, let's see, top volume, NEO. Jeez, IOP is just going crazy lately. All right, so I chose NEO because it's a lot easier to see these types of things with coins that have a lot of volume, a lot of liquidity. So spoof walls. Spoofing, like I said, is just like tricking people into trying to buy in or sell out, etc., etc. So let's see if we can spot a spoof wall over here. This is a spoof wall right here. You see, more than likely, 55 Bitcoin, but it's on the second page. So like no one's really, you know, there's 12 Bitcoin that needs to be chewed through before it even challenges this. So I'm pretty sure this was on the first page originally, and then it moved over to the second page once people started FOMOing in and started going in. But he probably left it there because if it shorts down, if people start taking profit and selling out, then his is still going to be at the bottom of the first page, and you always kind of want it easily viewable, either on the first or second page, because whenever people see that, they're going to think, oh wow, like people really want to buy this coin, like I'm going to buy in first before it goes crazy. But in reality, like this is, where'd it go? Oh, I didn't click it. In reality, this is oh, look at that, now it's on the third page. In reality, this is most likely not even going to fill. Jeez, this thing's bouncing around like crazy. It's most likely not even going to fill. It's just going to go hop from first, second, third page and just trick people into thinking that there's that support there when this guy obviously does not care at all. He's just leaving it there to throw up that fake support. And the same thing goes for sales. Let me see. See if we can find something around here. So and this is why it's best to phase out of coins. So say you wanted to short sell NEO, right? You sold 50% of your stack because you want to play really aggressive. Now the other 50%, you can place it on the ask portion on the sale book, and you can place it on top of another coin like this, or another order like this 3.6. You place like, you know, 7 Bitcoin there or something like that. So in total, it'd come out to 10 Bitcoin, and it'll look like someone's trying to sell 10 Bitcoin. Now, a noob would come in and be like, oh, they're dumping the markets. There's no way that we're going to break that volume, et cetera, et cetera. And then they start placing their own sale orders before yours for theirs to fill out first, or they'll just dump the market. And then once the price goes low enough for you to buy back in, or it fills your order, you just remove your sell order, and then you just let the price bounce back up, and you just let the wave ride, basically. So that's spoofing, and it's a really big common strategy used by whales. I mean, I use it myself quite often. Well, not as much anymore, because I've changed my strategy a lot. I'm not that much of an aggressive trader anymore. AFK walls. You can see. Watch, we're gonna find an AFK wall easily. AFK walls are always usually in something like this: 7150000. Like if there was like a big order right here, you'd be able to tell that it's AFK wall. Because people are too lazy to type out 714848 whatever. They just put 715 enter. That's it. Let's see if we can find another one that. See, like 0.0072 4.4, which isn't a really big sell order, but you know, it's probably multiple people putting in a bunch of small orders there to make that wall. And I'm sure if we go to like 7.5 or something, we'll be able to see another one. See, like right here, 13 BTC, 7.3. See, it never fails. Every single time there's like this is the AFK wall. Let's see if we can find 7.4. Nope. 7.5. Yep, look at this, another one. 7.5, 41 BTC. This isn't used to scare anybody. It's on the 16th page, but people are just lazy and they just put, you know, 0.0075 and they just leave it there. And they're happy with that and they'll take profits with that. This is most likely a bunch of different people's orders, but it accumulates up to 41 Bitcoin. So that's an AFK wall. A lot of people are like, oh, there's this wall, oh, there's this wall there. It's just a whale trying to scare you. If it's an even number, it's most likely not a whale. It's most likely just the AFK wall. And the way that you'd be able to tell the difference between spoofing and a real support or a real sell order is that most people won't put it like for this one. If this guy wanted to get out, where's that? Oh, like you see, his wall's gone. See, told you it was a spoof. You don't see the that wall that was around. Obvious, fake wall was obvious. So if that guy really did want to buy in at this rate, he wouldn't keep it on the second page or anything like that. He would buy in closer to the top, because that's how you can, you know, basically have a higher chance of getting your order filled instead of being a little bit lower where people won't fill your orders at all, because there's other people that are trying to get in and they'll, you know, try to beat you out of getting your order filled, etc., etc. So that's how you can tell the difference with all of those. And the same thing with the sells. If someone's trying to exit, instead of having like a big order down here, they'll most likely have their order up here. So just keep that in mind. So that's spoofing, AFK walls, buy sell walls, and the depth chart is just useless. Just don't use it. I think it's this right here. Yeah, there's not much to really care about in terms of looking at this right here. You'll see like giant green walls, or, you know, spoof or scale walls or whatever, but they're not as effective. They're not as, I mean, if you figure out the whole thing with spoofing, like just looking at the depth chart isn't really effective. Just stick to the timeline, stick to reading the order logs yourself and figuring out, you know, whale manipulation and AFK walls, etc., etc. So those are the basic indicators for this lesson. I'm gonna go ahead and answer questions from the YouTube live chat. Let's see there we go. All right, so anybody had a question, let me know. Make sure that it pertains to TA, preferably the stuff that we just recently talked about or from the last lesson, and I'll do my best to answer them. Let's see what's going on with Monaco. Or not Monaco, Meadow. Yeah, so you can see broke down. Now Meadow's in this bearish market until it starts to go sideways and break out of the cloud and go bullish again. But it's all right. There's a lot of bullish good news for Meadow next month, so I'm not too worried about it. I mean, it's still 20. No, it's at 20. It's not good, but it's alright. And 20%. I hope you enjoyed the stream. And with all of that, it's midnight now, so I'm gonna get some sleep. Have a good night. Ciao.